Moving on, continuing with the theme of royalty, the ATO has also recently re-released a text draft ruling, TR 2024/D1, which sets out the Commissioner's view on payments made in respect of software arrangements that may be characterized as royalty and therefore subject to withholding taxes of between 5 to 30%, depending on the treaty, if any. The ruling covers payments for software licensing, software as a service, and software distribution agreements. A couple of key points to take note from the ruling are that the ATO considers arrangements for payments of tangible goods with embedded software may constitute royalty if the distributor is granted or uses the right of the IP. They take a substance over form approach where not only the terms of the agreements are considered, it also examines the underlying facts and circumstances from an economic and commercial point of view, as they have done so in PepsiCo. An amount can be a royalty, even if it's not periodically or however so described in an agreement. They've also taken a vastly expanded and liberal interpretation of the definition of copyright and will consider reference to any work that's protected by domestic and foreign copyright laws and international copyright treaties. The ATO view also somewhat deviates from OECD commentary, which recommends that a distributor can obtain certain rights related to the copyright, as long as these rights are limited to being necessary for the purpose of the distributions. In that case, payments should not constitute a royalty and be taxed as business profits instead. However, the ATO considers the act of granting access and making a software available online for cloud distribution or SaaS as an exclusive right of the copyright owner and therefore using the copyright. Though unlikely but entirely plausible, there can be an unintended mismatch where the licensor country determines that the payments to be business profits and deny any offsets or credits arising from the Australian withholding tax. Next slide, please. I'll now quickly go through a scenario from the draft ruling that illustrates the ATO view. In this case, the key terms of the agreement between AusCo and ForCo include that AusCo is granted a non-exclusive right to resell software products of ForCo. These products are sold to AusCo for resale. AusCo must maintain and enhance the brand image of ForCo and its products in Australia. However, AusCo does not have any rights or license to any IP owned by ForCo, but they are granted access to confidential information and know-how of the products. In terms of products, ForCo's products include computer software available from download from service owned by ForCo offshore and which is directly installed into the end user's personal devices, or cloud-based software that's accessible via the internet and installed on service owned by ForCo. Whilst end users enters into a sales contract with AusCo, the order fulfillment is actually done through ForCo, granting a limited license to download or access those ForCo service. Finally, AusCo is required to pay an amount as not net profit from sale, less a small margin representing an arm's length fee for distribution services. The Commissioner considers payment by AusCo as a royalty because although the end users pay AusCo to obtain the right and entitlement to use the software, such a right cannot be approved by AusCo without authorization or communication by ForCo as the underlying copyright owner. In addition, the payment provides AusCo with access to other associated rights, such as the supply of technical and commercial know-how by ForCo, the right to use the trademarks designs to promote their products in Australia, the right to enter into a commercial rental arrangement in respect of the software, that's like a recurring subscription fee for a license, and permission to access software that is proprietary protected by ForCo. The ATO is of the view that the IP rights are non-severable from other rights, and the distribution agreement cannot be performed without the IP. Apportionment may be appropriate if it can be shown that the distribution right has substantial value independent of the right to use the copyright or other IPs. However, no further guidance is provided in the tech draft ruling on the basis of apportionment other than being on a fair and reasonable basis. As you can see, the starting position is that the undissected payment, if it's sufficiently connected with the definition of royalty, the entire amount is treated as a royalty, and the onus is on the taxpayer to prove that it's not. To wrap up my section, Australian distributors should review their existing and proposed software distribution agreements and take caution if payments are not currently characterized as royalties. Also, there may be scope for increased tax liability if the agreement contains a tax gross-up provision. Whilst the draft ruling only focused on software arrangements, it would not be unreasonable or surprising to expect similar positions being adopted by the ATO in relation to any distribution agreements in other industries such as pharmaceutical, healthcare, etc.